Let's go to Jason Schenker on this, president of Prestige Economics. Jason, thanks for joining us. So 411,000 barrels increase a day. They've already increased the past couple of months. Is there demand for this in the market? Do you see that?
Well, the global economy, we see right now is in a very tight supply-demand balance with crude oil. So, in other words, demand remains relatively strong because of long-term dynamics, but supplies and inventories have been relatively tight. The push and pull around prices we've seen recently has been significantly impacted by trade and tariff uncertainty. But as for these increases, these are not tremendously large monthly increases. These are relatively small numbers. And by the way, these are, of course, are additional voluntary cuts that are now being rolled off. And we do see a tight market where even things like the Canadian oil fires are impacting some areas of supply.
Yeah. Saudi Arabia may have been pushing for even more. What's behind that push?
Well, I think for Saudi Arabia, they do want to get production levels back up towards their full capacity. This is something they have been saying they did want to do, but this is something that's been in the works for a while. They have been curtailing the production now for a number of years, and so I think trying to get that production level back up is something they want to see. But of course, crude oil prices have been held back by a mix of a strong dollar and high interest rates, and of course now by trade and tariff concerns. Those things are holding prices down, but on the upside there are rising geopolitical risk concerns that could present more upside to crude prices. And then there are other disruption factors that can surprisingly hit the market at times, and even disrupting just tens of thousands or hundreds of thousands of barrels can have a significant impact on price dynamics.
So the price of oil today moved higher on the news from OPEC. Is that because the worst case scenario didn't come through?
Well, it's probably a mix of factors there. I think that I think that this might be some of what's driving the price. This OPEC announcement where not as much production will come to the market as some had thought might come. So in that case, it's not as much supply as anticipated. But again, then you have other disruption risks like we see from some of the facilities in the Canadian oil sands. I think that's a factor. And of course, geopolitical risks remain elevated and high. Risks of conflict spreading in Cold War II are going to be something we deal with for some time going forward, and those risks also present some upside to prices. But I think right now it is really that the less supply coming to the market than had been anticipated. That's probably the biggest thing in addition to some of these disruption risks.
So, Jason, how should investors manage all of this? Because as you mentioned, there's a lot feeding into different scenarios going forward for oil. So what are you saying to investors?
Well, I think right now looking at, and we advise a mix of folks from corporates who are looking to manage their price risk, both to the up and the downside, as well as to institutional investors. I mean, I think right now this is a time period of significant uncertainty. We are likely to see some bigger swings. We do think the average price of crude this year could be a little bit lower than last year, but we think next year it'll be higher than this year and higher the year after because of population growth, global growth, those kinds of dynamics. And we really need to be watching for those moments when we can see surprise pops to the upside. And the economic data, the trade data that we see coming in, and those geopolitical risks, especially where we see those tensions of Iran coming into alignment with Russia, with China, with North Korea, that's something to keep a continued eye on, because if we do see supply disruption coming out of the Persian Gulf or anywhere else of critical oil supply, and that can include somewhere like Canada, that's somewhere where you can get price pops.
Let me talk to you a bit about the wildfires. Cenovus is pausing some production in Alberta. Canadian Natural Resources has already done that. I'm just wondering when that becomes a real problem for supplying the Canadian production side of things.
Well, the biggest thing to consider, I think, when we're thinking about supply and demand in the oil market is we're not talking about disruptions of big barrels. Even the OPEC announcement, this is hundreds of thousands of barrels in a market that's almost 100 million barrels a day. So you'd think tens of thousands or hundreds of thousands of barrels might not matter that much. But the truth is, in the oil market, the price is set by the marginal barrels. And because supply and demand is pretty tight and inventories are relatively low, any kind of disruption presents a potential pop to the upside. And there's some asymmetric risks when that happens. That's something I would really consider that the viewers thinking about what's the impact in terms of Canadian disruption. Anytime you have barrels disrupted with a tight supply-demand balance and low inventories does present additional upside risk.
Jason Schenker, thanks for joining us today. Jason's the president of Prestige Economics.